Thank you for joining us. The following presentation is from a webinar titled How to Sell Your Business, Part 1, The Pre-Sale, originally produced on May 28th, 2014. The presenters are Kurt Trimarchi and Eric Blocher with McKonly Asbury, along with special guest Bob McCormack and Katie Smarilli from Murphy McCormack Capital Advisors. Enjoy the presentation and visit us online at www.macpas.com for information about our future events and upcoming webinars.
Welcome to today's webinar on how to sell your business, Part 1, the pre-sale. I'm Kurt Trimarchi, and today I'll be facilitating our conversation regarding what you have to do when considering selling your business. I'm a partner with McKonly Asbury, and I'll be joined today by one of my associates, Eric Blocher, who's a business valuation expert. McKonly Asbury is a 40-year regional accounting firm here in Central PA, where we've dealt with many issues regarding mergers and acquisitions, both on the buy side and on the sell side. And we're excited to be participating in today's webinar. We're equally excited to be joined today by a few associates from Murphy McCormack. Katie and Bob, allow you guys to introduce yourself. Why don't you go ahead and do that?
Hello, I'm Bob McCormack. I'm a partner with Murphy McCormack Capital Advisors. About 30 years of experience in the financial services industry, including commercial banking, where I was in various roles in commercial lending to the bank CEO. Murphy McCormack's focused on mergers and acquisitions of closely held businesses. We do have some expertise in certainly in business valuation, representing buyers and sellers. We also do corporate turnarounds as well. And with that, I'd like to introduce my partner, Katie Smarilli.
Hello, I'm Katie Smarilli, and I'm a partner with Murphy McCormack. It's really great to be here today with you. I have about 38 years of financial services background, and most recently about 5 here with Murphy McCormack, dealing with companies in transitions of all sizes, but closely held businesses. And we're excited to be talking about the pre-sale, getting your company ready for sale.
Thank you. This is Eric Blocher. I'm a principal with McKonly Asbury, and I lead our valuation practice. I've been performing business valuations for over 17 years, and I look forward to the presentation today. Thank you.
Thank you for those introductions. I think where we would naturally start as we think through the pre-sale process is we have an individual, maybe it's a client of our accounting firm, maybe it's a friend we run into at the country club, maybe it's somebody that reaches out to Murphy McCormack directly. But it starts with, hey, I think I'm ready to sell. Now, we know in an ideal situation, we'd like to take time years in advance of doing that to prep our company to be ready. But in some cases, that may or may not be the case. Regardless, when somebody comes to you and says, hi, I'm Joe, I'm ready to sell my business, what is it that you talk to them?
Kurt, I think you touched on it to some degree. You should start that planning process well in advance of the time you want to execute a transaction. And often the first step is the valuation. Getting somebody like Eric engaged in the process, reviewing the value of the business from primarily from a cash flow perspective, and really get an honest assessment of the value and honest assessment of areas that can be worked on to either reduce the risk of that cash flow stream or enhance that cash flow stream for a prospective buyer. Look at your personal financial statement. Is in many cases, closely held business owners, 80-90% of their wealth is tied up in the value of the business, and really have a plan in place in that sense, and then really commit to the process. If you're going to move forward with a sale, be engaged in that process. Move forward in that process. I think Katie can talk a little bit about clients that we've had in the past where they're lukewarm in the process, and that doesn't really have a positive outcome in many cases.
Well, yes, Bob. The critical aspect is that the seller really does think through the process of selling, the why behind it, and also really takes some time to clean up their financial reporting. And they really work hard at getting rid of the noise in their financials. There's been many individuals that we have worked with that haven't thought through why they're selling. So we really think it's critical that they think through the process. They have a commitment. It takes time. It takes, obviously, proper planning and the right advisors.
I think just to add to that, getting a quality valuation done and looking at the valuation from a fair market value, but also most likely selling price, net of taxes, net of debt being paid off, and having a quality firm involved in that process will also help in identifying areas of cleanup, such as the financial reporting, maybe upgrading the quality of the financial reporting from a tax return to a review basis, cleaning up some issues around inventory or accounts receivable or contracts that may not be assignable or transferable. And also, in many cases in closely held businesses, the tax tail wags the dog, and that is not always the best scenario for a business transaction.
Great, thank you. One of the areas that we talked about right there is starting with the net cash or cash flow perspective. I know with my own experiences that we often will look at a company's financials and normalize those back. Could you just touch upon that and maybe define it a little more, kind of where our starting point is with the discount? And Eric, why don't you go ahead and talk about that?
Yeah, a mentor of mine once said that cash is king, and I certainly follow along that thinking. And if you think from an investor's perspective, how are they going to get the money out of a business? And it's truly going to be from the cash flow of the company. So owners may have an idea of where they think the value lies, either some multiple of revenue or multiple of earnings that they've heard that their friend who has a similar business sold it for 5 times, 4 times revenue, 4 times or 5 times EBITDA, or some multiple that's out there. And really behind that number hidden is the cash flow of the business, because that's truly where they're going to get a return on their investment, and how they're going to pay for the investment they make in the company is going to come from the cash flow. So when I first meet with business owners that are thinking about selling their business, the first thing is I want to vet out any expectations that they may have, because I found many instances where they have, or the owners have, expectations as to what they think their business is going to sell, and then truly you need to meet and understand where their expectations are coming from. Is it from another transaction they've heard rumor of, that they heard so and so sold for this? Where do they think they're getting the money from? And most instances where I've done that, the expectations don't really line up with the reality of the situation. And I think it's really important to get in front of that with the business owner so that they have a good understanding and you understand where they're coming from. And then it's part of the education process, letting them know that an investor truly is going to be looking at the cash flows that they'll receive on their investment and the risk of receiving those cash flows. So it's a two-part equation really to help determine the value of a business. It's the cash that's available and the risk of receiving the cash funds.
Thanks, Eric. Appreciate that.
Yeah, I wanted to go into a little bit more detail of what an owner can expect from a business valuation, because my experience is that what they think a valuation is comprised of is pretty far from the truth of what actually happens. It's a process that goes into pretty much detail. The first thing that we do to get ready for a business valuation is I ask for financial statements for typically 5+ years, and I get those ahead of time, because what I like to do is spread the financial information, look at it, do an initial analysis, and then read through it, because what that'll do is that'll help me develop my detailed document request list. And this document request list sometimes drops the owner's drawer on the floor, and they have to pick it up and say, "You want what?" And it's a lot of information, but typically it overlays very nicely with a due diligence request that'll be discussed a little bit later. So we'll get the listing together to give to the owners about the information, documents, requests, stuff that we're truly going to need for the valuation to help determine the risk of the business, look at some of the factors we discussed earlier. What that'll do is we'll send them the document request list, get the information back, then we'll really start doing some of the detailed financial analysis. start developing some questions, and then what we'll do is we'll schedule a time to meet with the owners and key members of management and really, dive into some of the financial information, look at some questions that may come up, get some answers, some things that may not look right or, that look curious, and really dig deep into the financials and, operations of the company and learn more about it. Once we're done with that interview, then we can come back and we'll have, our valuation synthesis where we'll take that to, the final product of the valuation report.
We know we have a buyer that's committed to selling. We have some sense of that starting point around cash flow, and let's presume that we have reasonable financials either through an audit or review that were historical or we just performed so that we have good solid numbers. Why don't we talk about some of the other value issues or value drivers that we need to understand to really start to put together what this company might be worth?
Sure. I'll be glad to talk about that. First of all, the company's size as profit and sales are really going to drive, what type of buyer is going to be interested, whether their customer base is really diversified or their concentrations. One of the biggest questions you get is there one customer making up 95% of their sales? Believe it or not, there are people with one customer making up 95% of their sales, or are there multiple customers making up, smaller percentage of their sales? So they have diversification across their revenue streams. What is the market potential? Is it a growing market? Is it a declining market? Is it a market that really is challenged right now by really needing to shift and change? One of the things we'll take a hard look at is the balance sheet. Is there a strong asset base that impacts financing? There will be assets available for a potential buyer to utilize when they were looking at financing it? And what is the future competitiveness of the business, which ties into market potential? Then we really want to talk to that seller about their workforce. Do they have a strong leadership team in place? Do they have a great group of people that they know will be able to transition the business, depending on who they're selling to? And do they have a strong infrastructure in place, or is it tired? And do they have they deferred their capital expenditures for years? And so now a buyer's going to have to come in and really make a huge investment to keep the company moving the way it used to. So those are some of the drivers. Obviously, industry is critical when we look at the industry, but I would say those are the keys. Bob, is there anything you want to add to that I missed?
No, I think you touched on those, and I think Eric can add to this. Certainly, from a valuation perspective, those items that add to the cash flow stream at a minimization of the risk or will increase the valuation of the company. So when Katie touched on a 95% customer concentration, we see it a lot in the gas field service business where there's a 70% customer concentration. While it's an attractive cash flow stream, the risk of that cash flow stream being able to transfer to a new owner jeopardizes the valuation. So where normally you might see a 5 times multiple, you're seeing more of a 3 times multiple because of that one risk factor. If you're thinking about selling, think about diversifying your cash flow stream or making some assurances that that contract or that MSA can be transferred over to a new owner.
That's a good point. I've heard two things throughout this conversation that I want to highlight, and it comes down to a very simple equation. The numerator of which is the cash flow and the denominator of which is the risk of receiving the cash flow. And too often people focus on just the numerator, which is good. Let's reduce expenses, let's increase revenue. But the risk of getting those cash flows is really something that companies can focus on and should focus on, that can have a pretty high potential return on their investment. Yeah. So you don't just want to look at one aspect of it. You want to look at both aspects of it. The cash flows, what's available to the new owner, but then the risk of getting them. And you can reduce your risk in many different ways, not necessarily just some of the obvious ways. Like Katie mentioned, some of them, having a good management team in place is good. Not having all your eggs in one basket with either customers, suppliers, sales from a key man, was the owner that's going to sell. Is he the key individual who brings in all the sales? If that's there. That's certainly a key man risk, which lends to the riskiness of the company. Some of those are just other factors to consider, but it can be quite simple sometimes. It's just cash flows divided by the risk, but how you can affect each of those inputs is critical.
Eric, what you keep saying cash flow, and we got 2 CPAs, 3 CPAs, and a banker here. How do you define what cash flow means? Because I think that causes some confusion when we hear people talking about rule of thumbs out there.
Yeah, and that's something I've seen people and I've heard people talk about net income. And net income's this. Well, really, net income is not the cash that's available. You need to look at cash flow because a business has working capital needs. It has property, plant, and equipment, which I call CapEx needs, things that they need to have and uses for their cash that they need to monitor and to keep the business going the way it should and growing the way it should. So you can't just look at your net income because that number can be very misleading. Your net income also can have non-cash expenses in there, which really don't affect the cash flow of the business. But if you just look at net income, you really may not be considering the fact that you have a big purchase that you need to make next year, or that you have debt service requirements that you need to account for to pay down your debt, or working capital needs. So really what I'm talking about is the income from the operations of your business, that the cash that it generates is available for a return and distribution to your owners or to pay down debt.
Great, thanks. It sounds pretty complicated with all these different types of issues. I thought I was just selling my company for based off some multiple of net income or EBITDA, but it sounds like there's a whole host of issues I need to think through. In the pre-sale process, then, I guess it's going to take us some time to understand thoroughly what the real value of this business might be. One, to identify the different issues, both defining cash flow, defining all of the other items that you mentioned, Katie. In your experience, what's the timeline for something like that? I mean, how long does it take to reasonably get at least a solid starting point so I can evaluate whether I want to move forward?
I think one of the key pieces is that valuation process, and often when we're engaged by a client, we're doing pre-due diligence, and it's preparing an information memorandum, or we call it a confidential business review. Eric, in his analysis, doing a valuation, is often asking for a page or two worth of due diligence type of information. Very similar type questions we're asking as well. So it's typically a 30, 60-day prep process when you have somebody that's truly engaged in that sale process. That said, it may not be the best time. Eric may come back from evaluation, say, this is the valuation, this is the most likely selling price or structure that we see, this is your net cash flows after the sale. It might make more sense to wait a year or 2 or 3 and develop an action plan to either improve those cash flows, reduce risk, or just clean up the balance sheet noise, as Katie touched on a few moments ago. So the simple answer to your question, 30 to 60 days. The better question is, it really depends on that cash flow stream and the risk to it, and whether it makes more sense, or there might be some tax strategies that may need to be looked at as well.
Great.
Yeah, you raised a point, Kurt, about hearing some multiple that you want to sell it for, and to me, that's one of the first things that I talk with prospective clients about is, do they have any expectations about what they think their business is going to sell? Invariably, the answer comes back, oh, certainly I do. I think it's going to sell for this. And then my next question is, oh, well, what do you base that on? Well, Joe down the road sold his business for this. Well, do you know who he sold it to? Well, I heard he sold it to this. Do you know why they bought it? No. And it just invariably leads to a discussion, which is good with the client, about different standards of value. And that's one thing that I think business owners need to be more aware of. And in that, if Joe's business down the road was part of a roll-up process, where that company that bought them had synergies, or they wanted to have they wanted to expand their business, expand their footprint, or they had capacity they were trying to take care of. Once they bought that business and filled that capacity out, or that footprint, they may have been willing, or would have been willing, to pay more for that business than they would for any other business. And if there's no more roll-up situations, or that buyer's not interested in buying any more similar businesses, you may not have those opportunities available to you. So this multiple you heard from Joe may not even apply. It can be more of an investment value than a true fair market value. when a business comes to market, they may just be faced with selling to a single owner who's going to run the business similar to themselves. And then they would not have available to them any of the synergies, any expansion footprints, and quite honestly, the price that they would pay can and could be a lot lower. So I think setting up expectations with the client and where they come from is very good. You get it out of the way ahead of time, so I think clients appreciate that. You explain your thinking, your logic behind it. Now, what you may find is that there's a current roll-up situation where there are a slew of buyers, and that may very well be the case. And I know, speaking from experience, that I've seen that where the multiple that's paid really wouldn't be accessible in a fair market value standard. It's more from an investment value standard, and a single owner couldn't justify, or a single investor could not justify the price that was paid for the bigger institutional ones that are coming and buying up the smaller ones. So you really need to kind of know the situation that you're in, and the owners are the best place to start with that. And then it also smooths out any expectations and gets them thinking about different factors that could impact the selling price of the business ultimately.
Great. All good points, Eric. I do have one question for Katie and Bob as they think through this process and identifying the non-cash flow related value drivers, if I will call them that. In your experience, do you feel people that are in this early stage of selling, are business owners well-versed in those issues? Or do some of the things that get pointed out through the process of identification of different types of value drivers in their business, does that become new to them?
I'll let Katie add to this, but most entrepreneurs are risk takers. And that's how they became successful in their business. So they perceive that those things that we see risk, or a buyer will see risk to, as a normal course of their business. And they've found ways to mitigate that risk either through strong customer relations or vendor relations or things along those lines. When we pointed out to them, it does offer a great dialogue and opportunity for further exploration or further diversification of the business or things along those lines. Katie's working with a seller right now that's at the letter of intent stage, and that those type of risk factors have come up much in the conversation, such as not financeable, as an example. And I think she's done a great job educating him, and maybe she could touch on how to more fully answer that question than what I just did.
Yeah, I would say that business owners frequently are so tied up with running their business and keeping it going that sometimes they can be blind to some of those risk drivers. As Bob said, they're really risk takers. So to them, it's just a normal part of the business, and they've managed to mitigate those risks in their day-to-day. But when we present it, that there's a buyer who sees the cash flow potentially being at risk because of certain factors, whether it's concentration, or whether it's the fact that there's not a lot of assets to use in financing a deal. Those are some of the things that they sort of get, but they really haven't thought about. So I think that is an education process, and it is an education process all the way through, not just at the very beginning, but as we look at bringing the buyers on board and buyers start asking questions, then I think that the sellers get a chance to truly not just take our word for it, but see what in the industry their individuals that are looking at buying them are seeing as major risks. So that reinforces it, in addition to their accountants, their attorneys, and outside advisors that weigh in and help them along the way. So, I'm just building on what Bob said, but I agree. I think sometimes they're very clear about the risks, and sometimes they aren't.
No, thank you. Appreciate hearing your thoughts on that. It sure sounds like to me, if I'm a business owner and one of my long-term goals is creating value, that I should probably understand these types of issues long before I even contemplate a sale, so that I can focus my business on those types of issues, or at least my management team on those, as I focus on the other side of our business. So thanks.
I think one of the important things to go over with your client is that they really need to, when they're ready for sale, take a hard look at their business and compare them and benchmark their company with the industry and their competitors. They may not have been doing it all along, but I think it's a practice that they need to do. You need to really look at where you are, and it'll highlight the strengths of your company, which you'll certainly want to highlight to the sellers, but it will also pinpoint the areas for improvement where you can improve upon certain ratios, those would be the risk items. In particular, if your accounts receivable turnover is lower than the industry, you may not have even known that. But if you start picking up your accounts receivable turnover at the collections, you get a little better than the industry. The risk goes down. Another side effect of that is your cash flow goes up. So there's things like that you can really do to look at your internal operations, see what your strengths are, what your weaknesses are. It'll give you selling points to talk to the potential buyers, and then it'll give you areas of interest where you want to fix them or get better and more approved at them for, it'll take talking points away from any potential buyers. But that's something that I don't know if owners currently are doing. And I know we have a few tools in-house that we can really assist them with, to spread their financials, look at their ratios, and kind of see where they truly stand. And it can be quite an eye-opening experience for them. But I assure them that they need to do this, because if they don't do it, the seller is certainly going to do it. And they're going to point out all the low items. So, well, here, you realize you're below industry at inventory turnover, AP turnover and accounts receivable turnover, and the owner, I'd much rather have them say, do you realize I'm above the industry in this, this, and this, and that's why you should buy my business for this amount and not a lower amount.
All good points. Thanks. Great. Well, I feel like we're at a stage where we can say we have a committed seller. Maybe we've reasonably calculated what we think the company may be worth as perceived by others. But it kind of takes me back to high school and prom. And it's because you have a willing seller or somebody like myself willing to go to the prom doesn't mean somebody's willing to come with me. So in this case, we got to look for a buyer that's interested in our company. Tell me about the process we go through. How do we evaluate? How do we find them, first of all, I guess, and then how do we go through it and evaluate who would be a good suitor?
And that's a great lead into what often takes place in the evaluation process is a discussion around the buyer universe. And Eric touched on the standard of value. If the standard of value is an intrinsic value or a synergistic type value approach, then that may be looking at competitors or suppliers or vendors, customers potentially being a buyer out there. But typically, we're having that conversation early on with our client. And in many cases, clients will say, "I never want to sell to a certain competitor or group of competitors." They want to look at either private equity or family offices or somebody buying a job. In many cases, it depends on the business and the industry. Buyers may include such groups as private equity.
Can you explain private equity a bit, Bob?
And that's private equity comes in many forms. In many cases, it's a fund that raised capital. They might have been former business owners themselves that pulled their money and want to buy other businesses. They tend to be led by a professional group that are seeking acquisitions and are looking for a return on that investment and looking to grow that firm further, either do an IPO later or sell it again to another private equity firm. Private equity is a great source of potential buyers, but typically they're looking for companies that have an EBITDA north, earnings before interest, taxes, depreciation, amortization, north of $1 million, typically north of $2 million. There's hybrids of that. Family offices are very similar in many ways. They're often run by private trust companies, and in those cases they take a similar approach, but will take a much smaller EBITDA as a target market. Management's often a good source. We typically are asking the question in the early discussions: have you looked at all your family members? Have you looked at management as potential or key employees, or even as doing an employee stock ownership plan, an ESOP, as an alternative out there? As a potential buyer in that buyer universe, and that often will lead to a pretty good discussion. When you look at family members or employees or management to buy the company, one of the toughest questions is how you're going to finance the acquisition. You're often leveraging the cash flows and the collateral related to the business, and in many cases, the owner is taking back some subordinate financing to get those transactions done. And that will often drive the seller to other alternatives, a competitor, a synergistic buyer, a private equity family office type of buyer at that point.
So what we typically do is that we talk to the seller about who they think is a most likely buyer. And then, as Bob said, they say, take these people off the list. I don't want you talking to those individuals. We supplement their list with our research of potential buyers from the industry. They could be competitors. They may not be competitors. They could be private equity firms, depending on the size, or they could be individuals that have come to us to say we're ready to buy. And they could be a really great buyer from that standpoint, and that'd be in our database. We would have qualified them. The key is that we want to qualify anybody who's a potential buyer, make sure that they have the resources, and they would sign what we call a non-disclosure to make sure that they would not disclose any information that we would share with them. But more importantly, we, our firm, make sure that they have the capacity to purchase the individual who is selling, because what we would not want to do is present that company to a buyer that isn't qualified. So we spend a lot of time around that, and we do a lot of calling people personally to chat with them, really to say, this particular seller has asked us to give you a call because they've identified you as potentially great buyer. And we don't identify the name initially. We make sure we know they're qualified. We get them qualified, and they sign a non-disclosure. So they're either a financial buyer, a synergistic buyer, which means they could be a competitor, a supplier, or a customer that sees great value in adding that purchase to themselves, or they could be an individual. But all of those are people that go into the universe, and the most critical thing we do is make sure there's a non-disclosure signed and we qualify those individuals.
One of the points that Katie made that we should have probably touched on earlier is how critical maintaining a level of confidentiality is. Yes. Right from the start of the valuation process through the closing, and that often the worst enemy is the business owner themselves. It's real important that you keep it within a small group on your management team or within your family. You're not out there sharing it with customers or vendors. That increases the risk level of losing quality people or quality customers or quality vendors. And we take the confidentiality point very religiously. I know McKonly does as well, and it's very critical in this whole process. So the non-disclosure agreements often you asked about how do we identify buyers. One of the later questions is related to how do we negotiate with buyers. Sometimes the non-disclosure agreement's often an item of negotiation early on. Is it a 2-year expiration on it? How do you deal with vendors, common vendors, things along those lines? And we tend not to compromise in any way on the confidentiality agreement, on the NDA, and it's critical the business owner appreciates and understands that going into it.
Okay. Bob, you bring up an interesting point with sometimes the business owner being their own worst enemy. I know the situation that I've seen several times is when the business owner wants to sell, but then they limit the field of potential buyers considerably because they don't want to sell to a competitor. They don't want the risk of their business being moved, sold, or anything like that. And I find that you see this a lot in family-owned businesses where they truly develop a family atmosphere at work, and they want to try to take care of their employees even after a potential sale. But that can surely limit the potential buyers out there, but of the owner's own doing, and potentially can limit the sales price by having certain desires to come out of the sale.
And it's great you touched on that, Eric, and you could deal with that in the negotiation with the buyer universe. You can make it very clear that our employees are very valuable to this process and very valuable to this company, and have the buyer understand that and appreciate that, and then want to make sure that they're taken well care of. Again, Katie's negotiating a transaction right now where the business owner made it very clear that the employees are a key part of this. And has been very strong in our negotiations with the buyer, and the buyer very much appreciates them as well. It's not a case where there's an argument in that sense, but it's good to lay that groundwork early on in that process, Eric. And you're right, if they want to guarantee an above market salary to an employee, that comes out of the cash flow stream, and that will affect the valuation. We're in North Carolina negotiating a buy-side agreement. In one of the cases, there's some key family members that are not working in the business but making $150,000 a year, the buyer's willing to keep them on, but it's going to come off the purchase price, and it's going to come off the purchase price at some multiple as well. And that doesn't make a very smooth process. That really means you really need to have that discussion early on.
Mm-hmm. You'll see a lot of employment contracts sometimes come out of situations like that.
Absolutely.
All right, so it sounds like we're at the point now where we have a willing seller, and we've just went through a process of starting to identify different types of buyers and understanding the seller's goals and eliminating some of those buyers as a result. But we're now down to where we have a reasonable list of a single buyer or maybe a couple of buyers potentially. How do we go through that next phase of starting to negotiate a deal, and what are the issues that we need to think about?
Well, one of the key viewpoints we have is one buyer is not a offer. You really need to have multiple buyers. Taking a step back before that, though, is identifying the process. You're selling a company, but the form of the transaction may be an asset purchase or stock purchase. In many cases, in most cases in closely held businesses, it's an asset purchase, and there's different tax consequences with an asset purchase or stock purchase. There's different indemnification issues that go on in the due diligence process and the documentation of the transaction. And Kurt, maybe you want to even touch on the tax differences between a stock sale and an asset sale, and then I could gladly jump back in and talk a little bit about how we typically negotiate with the buyer universe.
Sure. No, I think that's certainly a valid point. And then as a tax guy, and I'm always sensitive to being last to the party, I think, in too many deals instead of participating early on. So I think bringing this up is right on point. Obviously, sellers usually told by their accountant, some guy like me, well, we want to sell stock because it gives us this capital gains answer and it's the lowest tax. And buyers told we want to buy assets because we want to step up the basis and we don't want to assume their liabilities from the history of them running their business. The reality is it could be one or the other or somewhere in between, depending on how we structure it. But I think it's important to understand, even if we just reasonably estimate a sales price, as to what the after-tax yield looks like in a stock deal, what it looks like in an asset deal. Buyers sometimes are willing to maybe add to the sales price if they get the benefits of additional step up in the base in the assets, which gives them future depreciation and helps subsidize their deal costs. So maybe we can use that in negotiation. My experience is we get to that oftentimes too late in the process to really understand where our range is on our after-tax yield consequences so that we can negotiate properly. So I'm all over that aspect of, is it something that early on a potential seller should at least have some sense of what the tax issues are going to be and what they're actually going to walk away with based on a proposed range of sales prices. But other than that, what else should we be thinking about?
When we start the discussions with the buyer universe, we're typically not going out with you touched on a price. Typically, we're not going out with a price like a realtor would go. You're typically having a conversation, trying to understand the buyer universe. So if it's a synergistic buyer that Eric talked about earlier, that synergistic buyer, we may know there's some synergies either in revenues or cost savings and things along those lines. So we're talking about an EBITDA, adjusted EBITDA, with some of those savings in it and a multiple, driving a multiple to that piece. So we're often negotiating at the starting point of what is the EBITDA that we're talking about, or what is the cash flow stream we're looking at, and then we're also then looking at arguing over or discussing what the multiple that we feel is appropriate for this transaction. Typically, after that point, that's usually the starting point of those discussions, and then we're driving down to discussions about helping them feel comfortable with the risk of the cash flow stream, or the benefits of the cash flow stream, or their ability to grow the business, or capital expenditures. We often have a lot of discussions on, what's the annualized normalized capital expenditures in this industry. That often, when you're dealing with transportation companies or contractors where CapEx is real heavy, that free cash flow that's available to the debt service side or to the shareholders is often less than EBITDA. And so we often have discussions around around that. When there's a lot of growth in the company, we're often trying to get a piece of the new co in the form of equity or an earnout or some kind of sort of contingent payment. That's often, and potentially add on to the basic core deal structure. We're typically arguing over the mix of consideration. We may get a valuation of X, but the actual consideration may be X minus some sort of contingent payment. There might be seller financing in a deal, things along those lines. So that often is a big topic of discussion with buyers. You touched on asset purchase versus stock purchase. With an asset purchase, we're typically having a discussion early on. How do you foresee the asset allocation taking place? How much goodwill is going to be created in this transaction? And that helps us understand, too, how they're going to finance the deal. So if we can get a feel for how they're going to finance it, it gives us a little bit more leverage in negotiations, too. And we also think part of our value proposition is that we do have access to a good number of commercial banks. We understand the financing process. We understand the senior piece, the mezzanine piece. And that's a key component of being able to get the maximized net value to the client out there.
And just to add to that, in addition to negotiating and getting what we call an LOI or letter of intent coming in from a potential buyer after we have those discussions that has price, that has terms, and it also has deal structure, one of the keys is whether the current owner will stick around for a while. And many, many times the current buyer would like that. They'd like somebody in for at least a year to help them transition the business. And it all depends on who it is that's buying. But in a lot of the transactions we've discussed, sometimes they like somebody full-time for a year, full-time for 6 months, or they want to make sure that there's an identified individual within the company that will pick up things and run with the operation of the company. So it all depends. Now, if it is private equity purchasing, they may have a completely different methodology on whether or not they want that owner in. But the key to any good purchase is to make sure that that transition happens seamlessly, the cultures come together, and as Bob mentioned, all those things that that can make the deal work are thought out before you're in the midst of the closing. So I think that that's critical that you talk about all those things with potential buyer.
Hey, to that point, as far as the negotiation aspect at this stage of a deal, again, I'm representing the seller now. How actively involved in the actual negotiation is the seller, or how limited should they be? What's your thoughts on that?
My recommendation is the owner should run the business on a day-to-day basis and should not get caught up with the negotiation. If we're doing our job, we're talking to 100 different buyers at some stage in the process. If it's a fully marketed business, at that stage, we're trying to narrow down the what we think is a good match from a valuation perspective, a good match from a culture perspective that can get the deal done, and we're going to narrow it down to 3 to 5 quality buyers that we think can meet the terms that we're looking for. Then at that stage, the owner typically is getting involved, at least either a phone conversation or an in-person meeting. And again, still in a high level of confidentiality where they might be the banker or the insurance agent or the CPA coming out, not necessarily a buyer. And we're having kind of high level discussions and letting the business owner share his value proposition, why he believes there's growth or some opportunity with this business. We think before that point, we have a confidential business review that should be sharing that, but hearing it from the owner is often a key. Once we develop the letter of intent or start developing the letter of intent, we again think it's our job to drive that letter of intent as complete as possible. So we're talking about the due diligence period. We're talking about how due diligence is going to be run. Things like the asset allocation is often discussed in those, how it's going to be financed, when we're going to share information. And once we get close to the letter of intent being finalized, then we like to get the business owner back in to see if there's any hot points in there. Sometimes it might be we want to protect some key employees. It might be things around discussions around, if there's a lease or an earnout, maybe the earnout structure needs to be modified a little bit. But we really want the business owner to continue to drive his business like he's going to be running for the next 5 to 10 years. minimizing the risk to maximize that value or increase the cash flow stream, but let us, our firm, or a firm like ours, or the CPA firm, and the CPA firm and the law firm help mitigate some of that work that they have to do in negotiating these transactions.
Great. Within that, you mentioned the reference letter of intent, and I know I have had potential sellers looking, and they say they hear terms around binding and non-binding letter of intent. What do those terms mean from your perspective, if I'm, as you represent your seller, and what do they need, more importantly, to be concerned with?
I would say almost 100% of the letters of intent we see are non-binding other than the confidentiality section. So conceptually, once the business owner signs that non-disclosure agreement, the LOI, they're committing to sell to this owner in a process. Now, the buyer doesn't have to buy, the seller doesn't have to sell. But typically the buyer is spending, depending on the scale, $50,000, $100,000, $200,000 to $1 million in due diligence.
Okay.
So the seller really needs to be committed to that process at that point. They're also taking it off the market for 60, 90 days too. So they or we or other parties involved in that process cannot be communicating with other buyers out there and having buyer negotiations and things along those lines. But typically most letters of intent are non-binding other than the confidentiality piece.
Okay, great. No, I think that's an important point to have out there. Thank you. So now I understand what I'm signing when I look at this letter of intent. We get the signatures and parties agree to move forward. Let's talk about what those next steps are.
Well, I'll touch on a couple, and I'll ask Katie to jump in here as well. Typically, due diligence begins, more comprehensive due diligence. So the letter of intent may include language such as, we're going to have a quality of earnings audit. And that may be hiring a firm like McKonly Asbury to not just necessarily look at the financial records, but look at the quality of the vendor relationships and the quality of the customer relationships. Are the gross profit margins that are reported on the financial statements accurate? Is the work in process inventory, is that a real number?
Okay.
And really kind of drive down. Also looking at what is working capital. Often you'll see in a letter of intent a working capital covenant or some structure. And a buyer wants to buy a going concern, so they're going to want to see a level of working capital that's normal for their normal operation.
Can we just take a brief moment and talk, just define working capital?
Well, that's often a discussion. As strange as it sounds, arguing what is GAAP is often a discussion too.
Sure is.
Or what does EBITDA mean? But in most of these transactions, they're buying the current assets, and they're assuming the normal business accounts payable liabilities. Typically, the seller retains the cash. So they're going to identify a level of working capital that needs to operate the business on an ongoing basis. So if you're in a manufacturing business and your normal, Eric did his analysis when he did the valuation, said the typical current ratio is 2-to-1. They may identify that as a ratio to focus on, and that 2-to-1 may mean $1 million in accounts receivable and inventory less payables as a net number. And if it's not there at closing, they may ask the seller to keep cash in the business, or they may give the seller more cash if there's a surplus in that. So they're really trying to transfer an operating company to the buyer. So working capital in this case typically is the current assets minus current liabilities, excluding bank debt.
And that can change drastically depending upon the niche that you're in and the industry that you're in. For example, if you're an automobile dealership, you have the floor plan liability, which typically is considered part of your working capital and not your long-term financing because it's secured by your inventory. Right. So there's some idiosyncratic stuff depending upon the industry that you need to be aware of going into any deal.
Yeah, I touched on, we're looking at buying, we have some offers out on companies in North Carolina right now. They're manufacturers in a very seasonal business. So we have some inventory adjustment numbers that are built into our letters of intent versus a working capital adjustment. And it's very similar to working capital adjustment, but it makes sense for the buyer to have a high level of inventory this time of the year to carry them through the fall. And if we get to the fall and the deal's not done, then the purchase price is going to change. So it has a net impact of in that sense.
So you're talking about the type of business, you're talking about timing depending on the type of business. And as you said, if it's an auto dealer with floor planning that becomes part of their current ratio, you've got a whole nother issue that you have to deal with.
Yeah, and we were talking about the letter of intent, so we're often dealing with the structures in the letter of intent. Typically, there's timelines when the agreements are going to be delivered, when the asset purchase agreement is going to be delivered, a draft, when the employment contracts, if there are non-competes, all those type of key items. In some larger deals with private equity, you'll often see a draft asset purchase agreement delivered with a letter of intent. Those are great because there's no surprises typically down the road, but more likely you're seeing it 30, 60, 90 days after the letter of intent signed, and if it completed some level of due diligence. Due diligence is a very intrusive process. We like to manage it on behalf of the client, so we kind of time things as if the buyer needs financing related items, then we get those to them first. And then we deliver some of the other things on a more timely basis. But if we're doing our job in the pre-due diligence and Eric's doing his job in the valuation piece, much of that due diligence items have already been developed. That's usually updating it to again, make the life easier for the business owner to have a focus on his business and have a successful sale in that process.
Can I ask at this point, as a seller, obviously I'm worried about how many people know I'm selling my business. That's always a concern. So now we're into due diligence. So I'm opening up the risk of people finding out who outside of yourselves from my company as a seller, who's usually involved in the due diligence process?
It depends. I would in many cases it's usually the business owner and maybe the CFO. Yeah. And that's a critical discussion because if the CFO is not staying with the NewCo and there's no severance package, that gets a little muddy. Yes. So it's critical, and I know Katie likes to have that conversation very early on in the process with our clients, and it's a critical piece of that process. We're often setting up data rooms too. That really kind of limits the exposure with inside the firm, and much of the due diligence is done remotely now. Okay. We have very seldom due diligence that's on site, and if it is, it looks like a bank appraisal or a phase one environmental or things along those lines. Maybe there's somebody walking around doing an inventory check. That looks often like a CPA firm, and many of the quality earnings audits, most of them are done by CPA firms. So again, from a confidentiality perspective, that exposure can be mitigated. But I know Katie likes to really have that, even in the valuation stage, she tends to have that conversation early on in that process.
Do you want to talk about accounting advisors and also attorneys coming in and the due diligence and when they come in?
Well, maybe even to take a step back in preparing the business for the sale. One of the first things we really recommend is that a business owner, they could keep their local CPA or keep their local attorney that does their day-to-day work, but really get with a CPA firm that understands business valuation, purchase price allocation, and knows how to deal with transactions. And the same thing applies to law firms. Really get with a quality attorney that has deal experience. They could talk to their CPA firm. They could talk to us. We all have recommendations. And it will make the process go much more smoothly. So you're not negotiating on things that can't be negotiated, but really focusing on the risk factors in that negotiation process.
And you're not running into roadblocks along the way that come up that, really if you had somebody who was very skilled at merger and acquisition business, they'd be able to fly through those roadblocks fairly quickly. And they'd be focused on doing the deal versus on, negotiating a point that doesn't necessarily need negotiated.
Yeah, I think that's a great point and key to maximizing value for a selling party.
Absolutely.
Certainly my experience suggests that as well. Well, let's just take a moment and kind of recap what we learned today. I think the journey to selling your business starts with ensuring that our financial reporting is in order. We start with that information so that we can reasonably calculate what the value of the business might be, in addition to the other issues besides the financial matters that we discussed about. We go through the process of identification of buyers and who might actually be a real buyer when it's all said and done. We don't want to waste our time spending resources and energy on non-starters. we want to understand maybe some of the tax planning around what the different types of structures could be and what our after-tax yield might look like before we get into heavy negotiation. We want to make sure that we have the right team in place, the right outside advisors, both in accountants and lawyers and investment bankers and any other parties to the deal. Is there anything else that you guys would add to the list?
Great job.
All right. Well, thanks again, and we'll look forward to coming back in part 2 and really getting down in the weeds on some of these issues.
We do have a couple questions that were sent in, and I'm going to read those, and we'll answer them for you. The first one says, when doing a valuation for an individual considering a sale of their business, how do you address the issue of significantly underreported inventory? Bob, would you like to handle that one?
Yeah, this comes up on occasion, dependent upon the industry. And what I like to do with that process, and I would like to, Eric, have your views as well, is really try to drill down and find out what the real inventory number is. And that might mean having a third-party firm value the inventory. You're going to rely on a little bit of management feedback on what the real inventory number is. Try to address the period where that inventory issue took place. Sometimes it goes the other way too, where it's over-reported. If it's over-reported often, then income and EBITDA is certainly over-reported. More likely we see the under-reported inventory. And potentially if it's over a long period of time, maybe we take a 5-year average and try to capture that in the cash flow. The negative impact of underreported inventory is it's not just a one-time event of capturing that inventory number, but it may be a multi-year cash flow event, which can certainly impact when a multiple is applied to the valuation. So it can have a real negative impact. The other thing I often recommend is potentially not putting it on the market for 2-3 years and try to capture that inventory and the real number into the cost of goods sold and into the and the balance sheet. The impact, of course, is you're going to pay taxes in that place. And Eric, I'd like to have your thoughts.
Yeah, I agree with what you said. Now, something that's out there is if inventory is either over or underreported, you may have an IRS issue on your hands that the company may not want. So that certainly lends to maybe postponing a little bit. If you think it through, like what Bob said, if inventory is undervalued, I mean, cost of sales was overstated, and you had more expenses, less net income, if the valuation would be based on that number, it would come in low. So you would want to certainly look at it some more, try to isolate when it happened, as Bob said, and then potentially look to getting a separate inventory appraisal so that you can justify it to a current seller or buyer if you're going to look to still move forward with the transaction. Okay. Next question that we have says, if you're thinking about selling your business within the next 5 years, would it be best to have a valuation done early when you're considering selling in order to pinpoint areas that a buyer might view as a weakness in your business? They then say that might give you a chance to make some changes in order to make it more appealing to a buyer, or is there another less invasive service that could than a business valuation that would be helpful? Well, the first part of that question, I certainly agree with. I like to get a valuation done early because, one, it gives you time to address any changes that you need to, or to basically make the business as good looking as it can be for sale. You can address issues if there's the valuation determines a value that you really weren't expecting. You don't have to take it immediately to sale. You can see what areas are the easiest to fix or improve, and what you can really do to make it better. It gives you time. You're not under the gun. You don't have to sell it for what it is right now, and that's the best scenario in my opinion. Secondly, you don't have to have a full business valuation. There are different levels of services that I won't go into a great deal of detail with right now, but there's a lesser service called a calculation that is a little lighter on the reporting side of it, but it can certainly look at some key issues and give you a range or an approximation of value that will be less invasive and less expensive, and will give you a good idea. So that's another option that you can do starting with.
And we following up a little bit on what Eric mentioned there, we like to do a most likely selling price in conjunction with the valuation, which drills down to what we likely see the structure to be, who the likely buyer universe may be, and then look at it from a net of taxes as well. And often that will lead to the discussion about how to clean up the business. Maybe you want to defer for a couple of years, but it also leads to some structural things you may want to look in the transaction as well. That leads to the net cash after closing really is what matters to the selling shareholders.
Yeah, and I just chime in and say that to plan for the future and make sure you're focused on the right thing as you're setting the company up for sale, it's always great to get an advisor who is an expert that can help guide you and at least give you the key points for focus over a couple of years, or even if it's a shorter term. So I've seen the process not be invasive or eBay or whatever invasive we're talking about, but I do think it's really important to start with a professional that can help you.
Yeah, absolutely. We have one last question here that we can address. It says, it was mentioned that a concentration of customers and or revenue streams is a risk when considering the purchase of a company. How do you calculate the discount for this types of risk? Is there an opportunity for negotiation between the buyer and sellers to agree upon the discount? Katie.
Yes, I'll be glad to answer that. We always take a look at the customer concentrations as we're looking at the business valuation. We look at all risks. We'll look at concentration, we look at the industry, we look at size, general economic condition, what the financial reporting is like. But on the customer concentration side, we had a discussion here a little earlier about it can go a lot of different ways. You certainly have to identify it, but do you have solid contracts behind that customer concentration that perhaps a buyer would find incredibly valuable, that they may be able to also utilize those contracts or be able to renegotiate those contracts that will allow them, because it's a synergistic buyer, to be able to even drive more revenue. So I think when you look at the concentration, you have to think about who is the buyer. Is it private equity? Is it a synergistic buyer? Or is it a competitor? And then as you look at that, it can be a positive, it can be a negative. It is one of those things that we take a hard look at. And I know Bob does in his valuations, and I'm sure you do too, Eric, to factor that into the total risk related to the revenue streams.
Well, the only thing I would add there is when you're doing a fair market value valuation, maybe not for a sale, you're assuming a hypothetical buyer. So you're not necessarily looking at a synergistic buyer that may be wanting to buy a Walmart contract or a customer relationship like that, and the discount or the buildup related to that is very judgmental, and how much that company can mitigate the risk of a transfer of that contract in a transfer, or how long that contract's going to stay, or what are the parameters around that contract. So it's not every deal has the same number that gets built into that. The second part of that question is the ability to negotiate that. You're not usually negotiating the discount rate with a buyer seller. You're usually negotiating the value, the price, and the deal structure. So the answer to that question is yes, but it's not really drilled down to the discount rate.
We'd like to thank you once again for joining us for this presentation presented by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thank you again and have a great day.